Hi, I'm Ron Chakler with American Portfolios. There's little doubt that one of the most popular investment vehicles used by portfolio managers today is the ETF. But despite its popularity, there's still many questions about what they are, how they work, and why they're beneficial in a client's portfolio. ETFs stand for Exchange Traded Fund. It combines some of the features of a mutual fund with some of the features of individual stocks. Like a mutual fund, the ETF gives investors exposure to a pooling of securities through a single transaction. But like a stock, ETFs are traded on exchanges at market-determined prices. Unlike most mutual funds, which have portfolio managers selecting the securities that make up the fund, the vast majority of ETFs are designed to track a specific index, downplaying stock picking in favor of owning the market, a specific sector, or an asset class. The first ETF to hit the market was in 1993 called the SPDR, which tracks the S&P 500, which is one of the most recognized benchmarks today. And despite the fact that there's now more than 700 ETFs trading today, the SPDR still remains the largest and most actively traded ETF. In 2008 alone, 164 new ETFs were launched. And by the end of August of this year, according to Barclays Global Investors, over $600 billion in assets were invested in ETFs, which gives you an idea of the popularity of the product. There are four primary advantages of ETFs over traditionally managed mutual funds. First and foremost is the transparency of knowing what is in the portfolio at any given time. Traditional mutual funds are only required to release portfolio holdings 4 times a year. Therefore, we are never quite sure what the makeup of a fund is at any specific point in time. Of course, there are also index funds that operate as traditional mutual funds, but ETFs report holdings on a daily basis. They also differ from mutual funds in that they are actively traded throughout the day like a stock, unlike a mutual fund, which is only priced once a day at the close of the market. This flexibility is much more valuable given the volatility that the market has and having the ability to buy and sell shares throughout any given day. And since the ETFs track a specific index, they are in many cases cheaper and have lower operating expenses than a traditional mutual fund. ETFs do not incur many of the administrative costs that mutual funds do for such things as correspondence, customer service, and account record keeping. Investors looking to target asset allocation strategies are finding ETFs to be a much more effective solution because they are certain to avoid the distortion of style drift, a strategy which some mutual funds have when they deviate away from their perceived style. ETFs are also generally more tax efficient than traditional mutual funds when you adopt a buy and hold strategy. Nearly all ETFs enjoy very low portfolio turnover inherent with indexing, so they typically pass on a small amount of capital gains to investors. However, certain types of ETFs, such as those that invest in small capitalization stocks or in specific market sectors, may experience higher turnover and be less tax efficient than broader market ETFs. Some of the other advantages are that ETFs have no minimum investment, so investors can buy a basket of securities with a very small amount of money. Also, ETFs can be margined to get greater exposure if you desire, or can be shorted to benefit from declining sectors, or to serve as a hedge to a long stock portfolio. Also, because shares are traded like stocks on an exchange, investors don't have to worry about mutual funds being forced to sell securities at depressed prices to meet investor redemptions. In conclusion, it's important to analyze an ETF the same way one would analyze a mutual fund before they purchase it. Determine which index the ETF tracks, the holdings and the weightings within the portfolio, look at the expense ratio, examine the performance of the index over various periods of time, and also the dividend yield, since dividends can, in many cases, play an important role in a portfolio's total return. I think once you get a better understanding of ETFs and feel more comfortable with them, you'll utilize them much more in your portfolios. Thank you very much for watching.